All right, let's get right into it. If you're a trader, you probably think you have a pretty good handle on risk, right? But what if the way most of us measure it is just fundamentally wrong? We're about to uncover a huge misunderstanding about trading risk that could be the single biggest threat to your entire account.
And boom, there it is. This really gets to the core of the issue. We're all taught the same thing. Manage your risk by controlling your position size or, setting your stop losses. But the truth is, that way of thinking, it completely misses the real danger, especially when the market starts to go haywire.
So first things first, let's just completely dismantle this myth. And it's a really dangerous one because it feels so intuitive. It feels so safe. But what it does is it hides a much bigger, nastier danger that's just lurking right under the surface.
Okay, forget all the complex statistical formulas for a minute. Let's just be real. When we're talking about short-term trading, like zero data expiration, or zero DTE, the real risk, the one that truly blows up accounts, is correlation. It has nothing to do with how many trades you have on. It's all about how many of those trades can get wiped out for the exact same reason at the exact same time.
And that leads us right into this crucial idea, this illusion of diversification. You see, a lot of traders, they build what they think are these really complex, multi-legged positions, and they think, hey, I've spread my risk out. But have they? Really? Let's break that down.
So you look at your screen, and this is what you see, right? You've got positions across a bunch of different strike prices, a few different types of spreads, maybe you even put them on at different times. It looks diversified, it feels diversified, and you're thinking to yourself, yeah, if one part of this fails, the other parts will hold up. But here's the hidden trap, and it's a big one. Despite all that complexity you see on the screen, every single one of those positions is chained to the exact same forces. They're all on the same underlying stock or index. They all expire on the very same day, and they're all going to react to the same shifts in market volatility. These are not independent bets, not at all.
Yeah, think about it like this. All that effort you went through to diversify, it didn't actually lower your real core risk. You basically just stacked 5 times as many chips on the exact same number at the roulette table.
Okay, so if counting trades and messing with individual position sizes is the wrong way to do it, then what's the right way? Well, this is where the pros think about things completely differently. They don't manage trades, they manage a budget.
I mean, look at this. It is a night and day difference in mindset. While a lot of retail traders are just obsessed with their win rate, right? Professionals, they are laser focused on something else entirely. They care about their total exposure to overlapping risk factors. In other words, they manage their correlation.
So what in the world is a correlation budget? Well, it's a hard and fast rule. It basically says you are only allowed to risk a certain amount of capital on a single idea or a single risk factor. Like a big spike in volatility or a huge move in the S&P. And once that budget is full, you stop. That's it. It doesn't matter how perfect the next setup looks. The shop is closed for that kind of risk for the rest of the day.
So why is this discipline so critical? Because in the wild world of zero-day options, correlation isn't some stable, gentle little thing. No, it is a monster that wakes up at the absolute worst possible moment.
This is the nightmare scenario every single trader dreads. You get a sudden shock to the market, volatility just explodes, gamma risk, which is just how fast your position's price sensitivity changes, it accelerates like crazy, and all the liquidity just dries up. And in those moments, all the little subtle differences between your positions, they just vanish. They become 100% correlated, and they all start bleeding money at the exact same time. And look, there's actually data to back this up. A simulation was run to test one thing and one thing only, the impact of correlation. Everything else, I'm talking the number of trades, the statistical edge, all of it was kept exactly the same. And the results, they are just stark. I mean, look at this chart. With low correlation, the worst 5% of outcomes give you a loss of about 4 units. Okay. But when you crank that correlation way up to simulate what happens in a real market panic, that same worst 5% of outcomes now gives you a loss of 8 units. The maximum pain literally doubled. So here's the key takeaway, the most important part. This isn't just a simple linear relationship. Stacking these correlated trades doesn't just add a little bit of extra risk. No, it creates a feedback loop that dramatically multiplies the severity of your worst-case scenario. This right here is the mathematical reason that accounts blow up.
Okay, so that's a lot of theory, I get it, but the most important part of any of this stuff is what you can actually do with the information, right? So let's get practical. Let's create a new rule for your trading.
From now on, before you place your next trade, I want you to just stop and ask yourself these 3 simple questions. Number 1, does this new trade lose money in the exact same scenario as my other trades? 2, does it depend on the same kind of volatility spike? And 3, does its gamma move in the same direction as my other position?
And the rule here is just brutally simple. If the answer is yes to any of those questions, you are not adding a new independent trade. You are just piling more size onto a bet you've already made. You're eating up more of that same correlation budget. And the pro move, the professional decision, is to not add the trade. Just walk away.
I mean, this quote just says it all, doesn't it? The huge fundamental shift in your thinking has to be moving away from just counting positions, and instead focusing on what is actually driving your profit and loss. It's all about seeing those hidden connections between all of your trades.
And really, that's the question I want to leave you with. When you look at your own trading, are you just counting the trees, the individual trades, or are you finally seeing the whole forest, the underlying risk drivers that connect everything? Because believe me, understanding that difference, well, that's what separates truly managing risk from just closing your eyes and hoping for the best.